I think the bond market was way too sanguine on rates over the course of the summer. I think, look, my concern all along, Scott, has been the trajectory of the move, and this is what we're seeing now as the market suddenly wakes up to ADP and Powell and ISM yesterday, and they panicked. I agree that 325 is important. I do not think we'll break 325 today. I think we need evidence in the form of ADP being confirmed by payrolls tomorrow. I think the ideal would be in 24 hours that we have a payroll number around 190 with average hourly earnings on expectations of 0.3, and the market will breathe. That brings your bond market back to 315. And then we focus on CPI, which will be the big number next Friday, which nobody's even talking about. So, yeah, I think tomorrow is a really critical day. I think if we were to see affirmation of ADP with payrolls up around 230, 240, this market's got a problem because you're going to see another very quick run in rates up to 335, and then the stock market is going down. So this is an adjustment. To Josh's point, investors have a choice now, which is a good thing. But I think the bond market just needs to calm down. The best way to do that is give them numbers that are more on expectations and that they don't surprise them.
Hey, Paul, it's Josh Brown. I want to ask you a question. I hear people now saying that maybe one of the better things that comes out of higher rates is that value investing comes back into favor. When you think about growth investing being predominantly driven by how much cash can be raised at almost zero cost, and as a result, how much money can be thrown at all kinds of outlandish projects, throwing spaghetti at the wall, et cetera, if capital becomes more scarce or at least more expensive in the next couple of years, then wouldn't it augur well for established companies in existing industries that have seen their multiple compressed by excess competition to now all of a sudden reassert themselves and investors say, hey, you know what, I do care again about balance sheet, about moat, about competitive incumbency. What are your thoughts on that concept?
Yeah, I don't disagree. Look, it's felt like free money, and now you're going to get a lot more choosy. I think one thing I would add to that, just to sort of divert the discussion a little bit, but companies have still got a lot of cash, and they want to put it somewhere. I think they still see tremendous value in Asia and Europe, but you're in the middle of a tariff war. So one of the key things that you could help this market with right now would be to take some of this tension off tariffs, which doesn't seem to be happening anytime soon. And so I think that level of uncertainty means there's too much focus on investing in the U.S. market because CEOs in the U.S. do not want to go international, and that's an issue. And the other thing to think about, the tariff impact from an inflation perspective is about to be felt in the U.S. Ask any builder, ask anyone who's in business, and they're saying, listen, prices are going up. So that tariff uncertainty cannot be underestimated, and the inflationary impact on rates that tariffs are doing is another factor that I would add to that, Josh.
You think, Paul, this is Scott again, that this trade war, battle, whatever you want to call it, with China has anything to do with what we're seeing in the move in rates from a standpoint of maybe China selling some treasuries?
There's been a lot of thought about that. I spoke to two people earlier in the week, and they think that China's been selling. The problem is nobody can ever prove it, and I don't tend to run on rumors. So my sense, Scott, is they're not selling. I think that actually rates should be higher, and the bond market got the Fed wrong. I mean, the Fed is telling you they're going to raise rates 3 times next year. They should be. Rates will be 1% higher in a year's time. But
maybe the market's in denial, as you said.
It's totally in denial. There was a major bank in the U.S. that was saying that December was on hold. I'd love to see that call today. I mean, the reality is the Fed needs to raise rates because there's tremendous growth out there. There's inflation kicking in. And one more thing, look at the price of energy. Right now, the consumer is faced with higher mortgage prices and higher prices at the gas pump unless they're driving a Tesla. So it's getting more expensive out there, and the Fed is telling you that, and as a result, they're raising rates.
Did I hear